This is Alan Bush with ADMIS. In the stock index futures, we did see pressure in the overnight trade. This due to news that the World Bank downgraded their estimate for growth in the global economy. However, there was a much more severe decline when retail sales here in the U.S. came in down 0.9%. That compares to the estimate of down 0.1%. So a lot of pressure on that news. Since then, we have come back a little bit. So even though the economy is apparently weakening, according to this latest report, I would not be overly concerned, since any weakness, either here in the U.S. or globally in the economy, will be met by more quantitative easing. At least here in the U.S., it appears very likely that the Fed will be forced to delay a rate increase. I would not be surprised to see 2016 for the timing for the Fed to raise interest rates, which is very much a minority view. Most analysts are looking for in the second half of this year. So any economic weakness will likely be met by more economic stimulus, which means that this bull market for stock index futures is not over. Over in the currencies, the weak retail sales report very suddenly putting pressure on the dollar index. This also is the main reason for all of the gains that we are seeing in the other major currencies to one degree or another. However, we feel once a consolidation period is out of the way, maybe a couple of days, I think we can see the dollar index resume its uptrend. Even though the Fed is likely to delay a rate increase, the Fed is still more hawkish than the other major central banks around the world, meaning that the dollar index should continue to gain from an interest rate differential point of view. After a couple of days of consolidation in the European currencies, I think we can see a move to lower again, especially in the euro currency, in advance of the very likely probability that the ECB will announce a QE program at their meeting on January 22nd. However, I would not sell the yen. There's a flight to quality bid coming into the yen due to the problems in Greece. So I'd wait till after the Greek elections are out of the way on January 25th. Around that period, I think, is the time to re-enter shorts in the yen. And interest rate markets, 30-year bonds trading at its highest level since December of 2012. Nothing changing there. Still looking for higher in the Treasury instruments, especially for the 30-year bonds. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.